Geopolitical tensions in the Middle East are already creating ripples through the global economy. Energy prices are surging and the threat of inflation is imminent. Well, here to share more on rising costs and portfolio shifts is Bill Dendy, financial strategist. Thank you so much for joining us.
Great to be with you. And it's been a really wild ride on Wall Street, oil prices and the stock market both.
Yeah, absolutely. And we're hearing the word stagflation. It's a term that we've heard in the past. Economists are employing this term to explain what's happening right now during the Iran conflict. Can you explain what that term means in comparison to, say, inflation or a recession, depression type of economy?
Well, oftentimes we have inflation because the economy is overheated. Everybody's buying things, a lot of demand, limited goods, so prices move up. It's usually a result of a positive thing. The economy's growing, that's positive, but because everybody's out there making more money, they push the prices higher. And so that's normal growth with inflation. Stagflation is the economy's not growing. We're actually maybe shrinking, but the prices of things are going up. And that's the risk that we face if we have a prolonged conflict in the Middle East.
So gas is already climbing to more than 50 cents a gallon, reaching nearly $3 here in South Carolina. Why do we experience such a quick response to oil prices if we do have reserve barrels?
We still, even though we manufacture so much oil, we're producing so much oil here in the United States, we still are impacted by global prices. Oil is still bought on the global market. And so a increase, which happens in real time, quickly trickles in down to everything, right into our households where we're purchasing anything that is transported, which is most of the goods that we have. We start to see that increased cost in gasoline, in diesel fuel. And once those prices go up, rarely are they absorbed by the intermediaries. They're usually passed on to the consumer. So we see the gas prices instantaneously, but everything else will follow if it's a prolonged conflict.
Yeah, well, the rise in oil prices does make basically everything go up, and we saw inflation actually cooling in January of 2026 to 2.4%, but does this bode for inflation possibly going back up again?
Yes, and a lot of analysts have already built in Europe, especially about a 0.5% increase in inflation just because of the conflict and where it stands today. The Fed is not expected to lower rates as we had intended, as we thought they were going to do. They're going to stand back and see how does this Middle East conflict resolve itself. Does it resolve? Because we have the risk of this 0.5% or more inflationary tendency because of the increased price of oil.
What does this mean for people who want to borrow on a mortgage or a credit card?
Well, the credit card rates are oftentimes very sensitive to the Fed funds rates. Variable interest rates on mortgages can be sensitive. The longer term mortgage rates, the 15 and 30 years, not quite, but we were expecting to see these rates go down and continue to go down for some time, and to pause or to go the other direction would shake up financial markets. Financial markets do better when interest rates are lower. The White House is one of those rates to be lowered a year or two ago. And rates started to come down at this point, but they may pause, which pause may be okay. But if they go the other way and start raising rates, that would have a ripple effect throughout financial markets.
Absolutely. Well, we only have a few seconds left. I want to get to this. Gold and silver are dropping, and some portfolios are also dipping. So are we looking at possibly a bear market, and how should investors navigate these choppy waters?
These choppy waters are a reminder to all investors that things can change in a hurry, and it's geopolitical risk, but we see it in our portfolios almost instantaneously. And so if we've gotten too comfortable with the market because it's been doing so well for so long, this bump that we've just witnessed, if it makes a person feel very uncomfortable, probably they should be repositioning their overall portfolio to make sure that they are able to ride through a real downturn in the market. A real downturn isn't just a couple days. A real downturn can last 9 months or longer. A real downturn is not just 5%. It is 25, 30 to 50% down like we saw in the year 2000 and 2008.
Well, Bill Dendy, thank you so much for joining us. Really great advice.
God bless you. Always a pleasure.
Thank you.